Imagine living in a world where your financial future is not just secure, but flourishing. You're not just surviving, you're thriving, making smart investments that compound over time, creating a legacy of wealth. This isn't a fantasy, it's a practical reality that can be achieved by mastering the principles laid out by Benjamin Graham in his seminal book, The Intelligent Investor. As we delve into the wisdom of one of the greatest investment advisors of the 20th century, we'll uncover the strategic approaches that have shaped the world of investing today. Let's transform these principles into actionable steps that can lead to financial independence and success. Benjamin Graham's The Intelligent Investor is not just a book, it's a blueprint for financial freedom. Graham distinguishes clear between investing and speculating. While speculators play a dangerous game of risk, true investors engage with the market like a business, focusing on solid long-term gains. Understanding Graham's philosophy starts with recognizing that investing is an art that requires knowledge, discipline, and an unemotional approach. The intelligent investor sees beyond the ephemeral ups and downs of the market, focusing instead on the underlying values of investment. It is this disciplined methodology that can lead an ordinary individual to extraordinary wealth. Let's delve deeper into these transformative concepts that promise not just to change how you invest, but also to change how you view money itself. Inflation is an insidious force that erodes the purchasing power of money over time, making it a critical consideration for any investor. Graham's insight into the relationship between investing and inflation is profoundly relevant in today's economic environment. He advocates for intelligent investors to seek assets that not only maintain, but can potentially increase in value over time, thereby offering a hedge against inflation. Investments in companies with strong fundamentals and a solid history of growth can protect against the diminishing value of currency. Understanding these dynamics is crucial for building a portfolio that withstands the test of time and fluctuating economic conditions. Let's explore how to identify these assets and integrate them into a robust investment strategy. Mr. Market is a metaphor Graham uses to personify the mood swings of the stock market from euphoria to depression. This character is fickle, often offering prices that don't reflect the underlying value of the assets. The lesson here is not to be swayed by Mr. Market's manic depressive states. Intelligent investors must look beyond the noise, assessing the real value of their investments. By doing so, they can make rational decisions based on analytical reasoning rather than emotional reaction. This part of Graham's philosophy teaches us to maintain our equilibrium and make informed decisions, even when the market seems to be doing the opposite. Here's how to stay rational in an irrational market. Securities analysis is fundamental to Graham's investment strategy. It involves a thorough analysis of a company's financial statements, management, and market position to determine its true worth, termed as intrinsic value. Graham argues that the stock market is not always efficient, and securities can be overpriced or underpriced based on market sentiments. By using a disciplined approach to evaluate the intrinsic value of stocks, investors can identify and invest in undervalued stocks that offer a margin of safety. This method not only reduces risks, but also increases the potential for significant returns. Let's break down the basics of securities analysis to understand how it can be a powerful tool in the investor's arsenal. Diversification is a cornerstone of Graham's investment philosophy. It's about spreading investment risks across different assets to reduce the impact of any one underperforming investment. Graham suggests that a balanced investment portfolio should include both stocks and bonds, with the allocation shifting based on market conditions and personal risk tolerance. This approach not only safeguards the portfolio against market volatility, but also positions it to capture growth from different sectors. Here we will explore practical tips on how to build and maintain a diversified portfolio that aligns with both personal financial goals and the principles of the intelligent investor. Investing is not just a financial activity, it's also a psychological one. Graham pays significant attention to the psychological aspects that affect investing decisions, such as fear, greed, and herd mentality. By understanding and controlling these emotions, investors can avoid the common pitfalls that lead to poor investment decisions. Discipline and a contrarian approach, going against the market when it's driven by irrational exuberance, can lead to successful investment outcomes. We will delve into the ways to cultivate the mental resilience required to adhere to intelligent investment strategies, even in the face of market pressures. Defensive investing is about conserving capital and minimizing risk. Graham introduces this concept to help investors protect themselves during times of economic uncertainty or market downturns. This strategy involves choosing investments that are less volatile and more likely to preserve their value. Defensive stocks, for instance, often belong to companies that offer essential services or products with consistent demand. We'll look at examples of defensive investments and strategies that can help secure your financial base, regardless of what happens in the broader economy. Bear markets, characterized by falling stock prices, can be challenging for investors. However, they also offer unique opportunities to purchase valuable assets at lower prices. Graham advises that the intelligent investor should view these periods not with fear, but as opportunities to buy stocks at a discount. Patience and a keen eye for value are crucial in these times. This section will provide strategies for identifying potential investment opportunities in a bear market and how to capitalize on them without succumbing to the prevailing pessimism. Understanding the difference between stocks and bonds is crucial for any investor. Stocks offer ownership in a company and potential for growth, while bonds provide a fixed income stream, generally with lower risk. Graham discusses the merits of each and provides guidance on how to choose between them based on personal investment goals and market conditions. This balance is essential for creating a portfolio that can both grow and provide stability over time. Here, we will explore when and why you might choose to invest in stocks or bonds and how to approach these decisions intelligently. Selecting the right stocks is both an art and a science. Graham provides a framework for choosing stocks that involves analyzing a company's long-term prospects, quality of management, financial strength, and market stability. This approach is about finding companies that are not only undervalued by the market, but also have strong fundamentals that suggest they will perform well over time. We will dissect these criteria and discuss how to apply them to real-world scenarios to make informed and intelligent stock selections. Growth stocks represent companies that have potential for significant expansion and revenue increase. While these stocks can offer high returns, they also carry higher risk, especially if their growth prospects are overestimated by the market. Graham cautions investors about the allure of growth stocks and the danger of paying too much for an optimistic future. He suggests a balanced approach that considers both potential growth and current valuation. In this part, we will examine the characteristics of growth stocks and how to integrate them into your investment strategy without falling into common traps. Cyclical companies, such as those in manufacturing or consumer goods, have earnings that are closely tied to the economic cycle. These stocks can offer great returns during economic booms, but can suffer during downturns. Graham advises caution and careful timing when investing in cyclical companies. Understanding the cycles and the specific factors affecting these industries can lead to profitable investments. We'll explore how to analyze and invest in cyclical companies intelligently, maximizing returns while minimizing risks. Investing in tangible assets like real estate and commodities can diversify a portfolio and protect against inflation. However, these assets also come with unique challenges and risks. Today, I'll discuss the role of tangible assets in an investment portfolio and how they can complement more traditional investments like stocks and bonds. I'll emphasize the need for thorough research and understanding of these markets. This section will guide you through the benefits and potential pitfalls of investing in tangible assets, providing practical advice for incorporating them into your overall investment strategy. Long-term investment is at the heart of my philosophy. It's about looking beyond short-term fluctuations and focusing on the future potential of investments. This approach requires patience, discipline, and a deep understanding of market dynamics. Long-term investors are often rewarded with greater stability and potentially higher returns as they allow their investments time to mature. We will discuss the advantages of long-term investment strategies and highlight real-life examples where these strategies have led to significant financial success. Even the most seasoned investors can benefit from professional advice. I acknowledge the complexity of the financial markets and suggest that a qualified advisor can provide valuable insights and guidance. Choosing the right advisor is crucial, as they can influence major financial decisions. We will discuss what to look for in a financial advisor and how to ensure their advice aligns with your investment goals and strategies. The Intelligent Investor isn't just a guide to investing, it's a manifesto for financial independence. By embracing my principles, anyone can learn the art of investing intelligently, balancing risk, optimizing returns, and setting a course towards financial security. As we conclude, remember that the journey to becoming an intelligent investor is continuous. It demands diligence, education, and an unwavering commitment to sound principles. Start small, think big, and stay committed. Your financial future is in your hands.